everyone, and welcome back to the Mastermind course, How to Invest in the Stock Market, with yours truly, Romel Pravia. Now, most of you know that I am a certified financial planner. What that means is that I've taken on numerous courses and rigorous exams in order to earn the right to use the CFP designation, or the Certified Financial Planner's designation. Okay? If you're interested in starting a career in the financial planning field or in investments, contact me at romelpravia@pushmedia.agency, and I'd be happy to provide you with my 2 cents and advice on how to get to a certified financial planner's level. Okay? Now, we're on lecture 4, diversification and correlation. Okay? Let's begin by defining what diversification is. Diversification is a risk management technique that risks a wide variety of investments within a portfolio. Okay? The rationale behind this technique contends that a portfolio constructed of different kinds of investments will on average yield higher returns and pose a lower risk than any individual investment within the portfolio. Okay? Now, diversification strives to smooth out on systematic risk events in a portfolio, so the positive performance of some investments neutralizes the negative performance of others. Therefore, the benefits of diversification hold only if the securities in the portfolio are not perfectly correlated. Now, numerous studies and mathematical models have shown that maintaining a well-diversified portfolio of 25 to 30 stocks will provide you with a well-diversified portfolio, one that will weather the ups and downs of the market. Okay? Now, let's talk about correlation. Okay? Correlation is the relationship between one stock versus another. Okay? So I'll give you an example. Let's take the example of Company A being a cigarette company. Okay? And Company B being a space company. Now, do you think that the correlation will be high between Company A and Company B? The answer is no, because cigarettes have very little to do with a space company. Okay? So, let's now talk about the different types of correlations. There is -1, okay, negative correlation, 0, which is no correlation, and +1, which is a positive correlation. Okay, let's go through each one. Negative correlation, or having a -1 correlation. That means that if Company A's stock, okay, goes up by 10%, Company B stock will go down by 10%. Okay, they're negatively correlated. All right. Now, a 0 correlation or no correlation means that if Company A's stock goes up, okay, Company B stock will not go down by the same percentage. It will have absolutely no correlation. It may go up a little bit, okay, or it may go down a little bit again, but it will have no correlation. Okay, so it won't go with a negative correlation. If one goes up, the other one goes down. With 0 correlation, it may go up a little bit, but I'm talking about decimals. Okay, which means that there's 0 correlation, because we cannot have a perfect correlation per se. Okay, it is humanly impossible to have a perfect correlation. Okay, even though in modern portfolio theory you will hear of negatively or perfectly negative correlation and perfect positive correlation. Okay, now let's talk about a positive or a positive one correlated correlation. What that means is if a stock goes up 10%, okay, being stock A, stock B will also go up by 10%. Okay, now let's talk about the different types of portfolios. Okay, the first thing that an investment advisor or financial planner will do, and this is what you should do as well if you're thinking about investing in the stock market, is you need to go through an investor questionnaire in order to determine what type of investor you are. Whether you are risk averse, okay, or whether you like taking risk and therefore you like the high return, okay? Now, the first portfolio, it's a 100% fixed income portfolio. That type of portfolio has very little risk, okay? That being said, the return you're gonna get on it will also be lower. So, with a fixed income portfolio, your expected return may be anywhere between 2 to 3%, okay? Maybe 4 or 5% in a really bull market, okay? On the negative side, that fixed income portfolio may have a negative return of 3 to 5%, okay? So, the next portfolio, a 20% fixed income a 20% equity and 80% equity. 20% income, 80% income, and 20% equity. Okay? With that type of portfolio, you will essentially not be taking much risk. Okay? Having said that, you'll be taking more risk than that 100% fixed income. Okay? So, on the other side though, your negative returns will essentially be anywhere between 4 to 5%. Okay, so again, you're keeping your portfolio fairly risk averse. The next portfolio, which is the one that I usually recommend as I manage millions for my clients, okay, is the balanced portfolio, which has 60% equity and 40% income. Okay, the equity portion of the portfolio, okay, may include Canadian stocks, U.S. stocks, European stocks, and my favorite Asian stocks. Okay, and 40% will be fixed income, which will be government bonds, corporate bonds, treasury bills, and the like. Okay, now the expected return you're going to get on that portfolio is anywhere between 7 to 8% long term. Okay, on the downside, you may see a negative 5 to 6%. Okay, on that type of portfolio. All right, next portfolio, balance a growth. Okay, a balanced growth portfolio will have anywhere between 65 to 70% equity and anywhere between 25 to 30% income. Okay, again, it's geared towards more return than being risk averse. Okay, if you are a young investor, if you're a business owner, if you're an entrepreneur, okay, who doesn't have retirement for another 20, 25 years, you would want to take, okay, that type of risk, because long term you're gonna get a much better return. All right, and we all know, and studies have shown that investing in the stock market beats investing in real estate. Okay, now if you want to know more about that, let me know. I'd be happy to dispute and argue the fact that investing in the stock market is much better than investing in real estate. So with that, thank you so much for watching, and we'll see you at the next lecture.